Good morning. This is Kirk Spano. It is February 7th, 2020, and it is my 50th birthday. So let's talk about some things that I've learned in about 25 years of being an investor, and probably even more things that I learned back in high school when I first played with Apple stock in the 1980s, and heard from my grandfather and my parents, my uncles, and first landlord, some of my first bosses and coaches. A lot of things pile up in your head, and you start to try to make sense of it at certain points in your life. And I've decided that maybe I'll try to make some sense of them today. So let's start with aging demographics. We're going to work from the giant down to the small and back up to the giant again. And the biggest thing that we talk about is how aging demographics is impacting the economy and how people's earning and spending clearly drives the economy, right? So we've known for a very long time that the baby boomers were getting older. And we also have known for a very long time that 80% of them really don't have any money. So what's going to happen over the next decade? Well, in 2030, all of the baby boomers will be 65 or older. And a big hunk of them will be 70, 72, 75 years old, meaning that they'll be taking required minimum distributions, something that Bank of New York Mellon has been talking about a while as well. Why is it important? It's because there are drawdowns caused by the baby boomers. That is already going on. We know, don't have that chart today, but we know that the institutions, that was the chart I was looking for a moment ago and I didn't find. We know that the institutions, primarily led by pensions, are in a perpetual selling mode. So that is the headwind that the stock market is currently up against, and it will be up against for 30 years until sometime during that window the millennials start to put in more money than the baby boomers are taking out. Now, some of that will occur because of wealth transfer. Conservative baby boomer dies, passes the money down to millennial, the millennial becomes more aggressive with it. This whole ebb and flow is going to play out before our eyes over the next, like I said, 20 to 30 years. The big year that I keep talking about is 2030. That is the year that a lot of things will change. And when I say the year, let's fudge it by a year or two in either direction. We can't be too precise, and we don't know exactly when markets will react. But we know that we are going to be overwhelmed by the number of people who are turning 65 and 70 and start to go on Medicare and Social Security. Those charts are out there all over the place. I'm going to put them into a chart book as I update my Slow Growth Forever report sometime this spring, definitely before the end of the second quarter. And we know more and more people are getting government benefits. Now, the word that you hear thrown around is entitlement, as if that's a bad word. And I would say, well, is a pension an entitlement? Isn't a Social Security payment an entitlement? Is that bad? People have put money into their pensions. People have paid into Social Security. Probably not enough given life expectancies. However, the reality is these are benefits, entitlements, whatever you want to call them, that have at least been partially paid for and that people count on. So the idea of cutting these entitlements for older people, I think, is probably not on the table sort of thing. And can they trim around the edges to appeal to constituencies? Sure. However, the reality is that our expenses on healthcare and pension and Social Security are going to continue going up for an extended period of time until all of the baby boomers are receiving. And that is, again, about 2030. Now, certainly some people will work all the way to 70, 71, 72. Some will work longer of necessity. These things will all impact the economy greatly. We've known this, we've really understood it since the late 1970s, early 1980s, and yet we've done nothing about it. What we've chosen to do is become more and more indebted, print more and more money. At some point, there's a day of reckoning. I believe that we just print even more money because really we've borrowed from the future. At some point, you can't borrow from 100 years into the future anymore. At some point, you just say, okay, let's wipe out the debt. Let's issue some equity. Let's figure out how to do this. And that's what's coming someday. So between now and then, we have to deal with a stock market and bond markets that are slowly coming to the realization that there's a resolution point coming. And that's what we should always keep in the back of our mind. When does the resolution come? When do we fix a lot of these debt problems? They're all fixable. There's always a solution. Sometimes the solution has side effects, like inflation. Sometimes the solution has side effects that are even worse than inflation, like civil unrest. So if we really think this through, ultimately, as I've said over and over again, helicopter money is inevitable. We will eventually just print 20 or 30 trillion dollars, and that's a much bigger number than you hear anybody else saying. But it's clear that that's probably what we need to do. And as long as we put that money into a lockbox, it trickles in rather than flooding in, and we don't have the banana republic thing that people talk about. So all these people who try to scare you about the dollar, who try to sell you on the idea of Bitcoin, this digital gold, all these other things that are out there, you need to put back in your mind just a little bit and say, okay, are these guys just trying to cash in on the hype? Because in most cases, the answer is yes. And so that's my first lesson for today. I have learned in my 50 years that most of the stuff out there is hype designed to separate you from your money and me from my money. They are stories, they are narratives, they are hucksterisms, they are tomfoolery, they are shenanigans designed to get you worked up, to get you confused, to get you scared, and to get you to pay somebody to solve your problem that you may or may not even have right now. But you might, and it's scary. So I don't use a lot of fear tactics, even though I know they sell, because I think it's disingenuous, and I think there's better ways to make money. I think you can tell people what you think the truth is, and granted, your truth and my truth might be slightly different. I may see things a little bit differently than you do. You may have an expertise here that points out something to you that I don't see. But going back in time to the Bible, to the Wild West, there's always been people trying to scare you in a way that'll get you to buy the snake oil, to get on board something that other people bought cheaper, and somehow separate you from your money so that they have it. Who's they? Whoever. Sometimes they is just the salesman. Sometimes they is a class of people who are pumping a story, Bitcoin, in a way that will allow them to capitalize on you bidding up the price of something they already own. A lot of biotech stocks, right? Small cap stocks, penny stocks are subject to this all the time, the old pump and dump. So that is, I think, the biggest lesson I have learned is that stories especially scary stories, are designed to scare you out of your money. So I'm going to tell you a scary story. Eventually, we're going to have another Great Depression. Why? Because we're too dumb to know any better. But it won't last as long as the original Great Depression. It'll be fast. It'll have all the financial characteristics of the Great Depression, all compressed into a couple of years. Think about the Great Recession. We had an epic collapse that occurred during 2008 and 2009. By 2010, we had leveled out, we plateaued, and started to rebound. It's going to be like that. It's going to be 2 years of collapse, followed by the medicine that will come with its side effects, and then we'll get better again. And why will we get better again? Now, if you're a subscriber, you saw the very short list that I put out, right? You saw all the new watch lists, but you saw the brand new welcome page. And what was the theme of the welcome page? That things constantly get better. There were 6 charts in there. Bill Gates put one of them out on his Twitter feed to talk about how the world just keeps getting better. We keep having higher standards of living. Why? Because technology makes our lives easier. Because gradual inflation is actually a good thing. Because it allows working people to get ahead if they don't spend everything they earn. And obviously that's a problem because wages for the lower 60% of the population have been stuck in neutral for 40 years. 40 years, that's 2 generations. And the next 20% has made some marginal gains, and all the gains have gone to the top 20% really, with about 2/3 of those gains going to the top 1%. So when you have a system that is awesome, but it has inefficiencies and is open to manipulation by law, by taxation, regulation, chicanery, hucksterism, lying, cheating, and stealing, all the things that people are into, you start to say, oh, capitalism doesn't work. So here's my second point. Capitalism does work. It is why the United States has become the richest country on the planet. Not by a little, but by a lot. We are richer than any of the oil countries. We are richer than any of the European countries. We are richer than anybody out there. When you take the total valuation of all the assets in the United States and the productive capacity that we have, and then you divide it by the population, including all the illegal immigrants, per capita, nobody of all the large nations is richer than us. Now, are there a couple nations out there with a couple million people? Sure. Those are basically city-states that have a bunch of money because they stuck their fingers into the inefficiencies of the system, Singapore, and they were able to extract a lot of wealth through the financial system. In economics, there's a term just called inefficiencies. And inefficiencies are usually brought about by people manipulating the system somehow. Again, getting influence and power, having taxes changed in their favor, having regulations changed in their favor. The loophole, the special interest, the bribe, campaign donation, super PACs, corporations or people. All those things manifest in a way that ultimately there's huge discontent, and that causes disruptions. So the next big financial event that'll be negative, I believe, will correspond with the demographics we talked about and the wealth inequality that probably doesn't get fixed in the next decade. I mean, I hope it does. I hope that we preempt some of this. But history shows that we don't usually preempt. We typically wait for a crisis. So while we have people out there saying, hey, this is all coming, let's fix it now, we don't like to vote for them. Let's just keep it, let's just see what happens. Let's vote for the guy that will allow us to just see what happens. Okay, so we're going to see what happens. So over the next decade, as I've predicted, I think we get 2 recessions, maybe 3. 2 small ones and a big one. And the big one will have all the characteristics of the Great Recession. And remember, the only reason the Great Recession wasn't a Great Depression is because we injected trillions and trillions of dollars into a system and we let it trickle down. Created billionaires of the bankers that busted the world. Didn't really bail out the homeowners, but hey, they all moved in with somebody and then started to get back on their feet. How will this all play out? I don't know. But I know that a lot of things are coming in the 2020s. And I've been watching it weirdly since I was a teenager. Why did I start watching this stuff as a teenager? I don't know. My parents, my grandfather, Mr. Hintz, who was a teacher of mine, who got me to start looking at the economy and the stock market, the political nature of my college education with international relations. I don't know how these things play together. Mr. Pauly's class, where I decided, I really kind of want to be a Renaissance man. I want to learn a little bit about everything. I want to learn as much as I can about everything, which has made me, jack of all trades sort of guy. But I'm not a master of any one thing. But I understand what the masters tell me. So I can talk to an expert and ask the right questions. Can't do all the primary research because I don't have those specific skills. But I can go to the guy who's super brainy and say, hey, what about this? Because I think that if this happens, then that happens. Can this happen? And then they tell me how it could happen, how the scenarios could play out. And as an investor, that's what we have to know. How can the scenarios play out? It's not about speculating about which one will play out. It's about categorizing and assigning probabilities to the 2 or 3 or 4 or 5 scenarios that could play out. And the scenario that I think is most likely over the next decade is that the next decade is a lot like the 2000 to 2009 period. Will it be identical? No. Will it repeat exactly? No. But it's going to rhyme. Right? Mark Twain tells us history doesn't repeat, but it rhymes. The next decade is going to rhyme with the 2000 to 2009 period. All these things that I've watched for a long time tell me that that's probably going to happen. No, but what if it doesn't? What if the world just gets better again? And what if all the dumb things that we've done never come home to roost? That would be great. My standard of living will go up, even though I'm not fully invested financially. Everything will still get better. So on the one hand, things will be good. On the other hand, maybe great. Because even in the depression, 2 or 3 recession scenario over the next decade, things will still be pretty good. There will be pain for certain households that don't prepare, don't see it coming. They'll blame somebody else. They'll run to a politician. But if we look in the mirror, and the people who listen to this, the 4, 5, 6, 7, 800 people who listen to this every week, look in the mirror and say, okay, what can I do to try to get ahead and be prepared for those scenarios that seem to be coming? right? Plan for the rainy day. And if it's not rainy, you get to go out in the sun. So let's just take a look at some data out there. Labor participation rate. A little over 63%. I actually pulled up a better chart. I believe it is this one. So this is the labor participation rate. Why is this important? Because it really gives us an idea over time where the natural labor participation rate should be. And I said somewhere between 62 and 63% on this webinar a year and a half ago, maybe 2 years ago. And we are staying right in that range, a little higher actually. And this labor participation rate probably keeps drifting up. Why? Because older people are dying and there's a big generation of people who are starting to die. Baby boomers are just starting to die. So that means that as a percentage of the population, more people are going to be working because millennials are going to be a larger percentage of the population. And they're all in their working years. So this probably does drift up another point or two. Does it ever get all the way up to 67%? No. Why? Because of automation and machine learning. So ultimately, we have to find the balance on filling all the jobs that are available, and then navigate the change towards machine learning and artificial intelligence taking some of the jobs. People like Andrew Yang are saying, we're going to lose all these jobs. I don't think that's quite true. As one of the executives at CES said, the jobs of tomorrow haven't been created yet. Think about all the people that it takes to run the technology. Think about how an IT department really works. So the nature of jobs will change. We still need more skilled trade people for sure. We need a ton more engineers, and we're going to need more medical personnel. That's the future. The future isn't learning how to put a car together, because putting the new cars together they're easy. A lot less moving parts, a lot less dynamics needed to put these cars together, right? They're almost like snap-togethers. So that is something that we should keep in the back of our mind, is we know that the automotive industry is one of the largest employers when you include the downline, right? Not only the car company, but all the parts manufacturers and all the various services. If the auto industry needs a third less people, where do they go to work? Well, the younger people should get retrained into things that support the new industry, and the older people are going to have to find something that can carry them through retirement. A lot of them will get bought out because of the UAW, right? The UAW is not going to let just, all sorts of 50 and 60-year-olds go hungry. They've cut pretty good deals with GM and Ford. Now, that puts GM and Ford a little bit on the spot because they still have to transition. And if you listened to the Ford call the other day, CEO said, I don't know how long we can straddle the old and the new. Seems to me we ought to just jump into the new. I told you a month ago that was probably coming when I added Ford to our list of companies that we should watch. I told you about the Mustang. So all this change provides opportunities. So that's another lesson. This change is an opportunity. It scares most people, and it causes extreme thought patterns. But if you control your emotions, you just say, okay, change has always led to something good. There's speed bumps, we do dumb things as humans. But in reality, change is good. So as this labor participation rate changes, It's just going to reflect the reality of aging demographics and changing technology. What am I going through here right now? What are the 4 big trends that we follow? We just hit 2 of them. So to finish off the unemployment, since we had the unemployment report today, and I tell you to keep track of that, this is the total number of people unemployed. It's as low as it's ever been. And that's great. Now, interestingly, that started a long time ago. We're a decade into the unemployment picture getting better. This isn't sudden. This just didn't happen in the last couple of years. This is a long-term trend that's been going in our favor. Back when I was writing on Market Watch in this range, right? First half of the decade, I was writing for Market Watch. I said the oil boom was coming. It was going to change the way that the American economy works, because by 2019, we'd be energy independent, which is exactly the year that we hit. So 8 or 9 years ahead of time, and I'll have to pull that quote and stick it in an article. I hit that one on the nose. We're energy independent. People say, oh, we're not. We import from Canada. Who else are they going to send it to? We really get almost no oil from the Middle East anymore, which is why we're pulling out. And we are going to pull out. It's slow but sure, and there's some resolution that has to come there too. But ultimately, we're not going to fight those battles anymore. Is there one more coming? Maybe. I don't know. I think there's a conflict between Saudi Arabia and Iran brewing. I don't know what our role will be. We're just going to bomb the heck out of somebody and then say, clean it up yourself. You know, we introduced the circumstance. When we got rid of Saddam, that was about making Iran and Saudi Arabia come to a resolution, because we knew we didn't need their oil anymore. What will that resolution be? I hope it's peaceful. I hope they all say, you know, your God is your God, your beliefs are your beliefs. Let's just play nice. History says that's not going to happen, but I hope it does. So, in any case, back to the U.S. Unemployment rate is real low. There's a lot of jobs available. Number of people unemployed or looking for work is almost identical to the number of jobs available. And this is probably part of the juice from tax breaks. So this level here, you know, it's probably a little lower how many jobs we're really going to need. And I said about, several years ago, I said about 6 million jobs is kind of where the mismatch is on skills. We have a skills gap. And if we can fill it, if we can convince people to become engineers, if we can convince people to get into healthcare, a lot of nurses are needed, physician's assistants. And we can convince people to do the things where the jobs are open. Boy, we got a pretty good system, because these are all upgrade jobs. The idea that this is a bunch of hamburger flipping jobs is wrong. When you take a look at the jobs that are available, they're very technical. The jobs that aren't available are those ones where you get paid a lot of money for doing just a little bit, right? A lot of middle management jobs are gone. One of the themes at CES is that artificial intelligence really isn't going to replace the $10, $15 an hour job. It's going to replace the MBA, who's not really bringing all that much to the table. So a lot of these middle management people who are just trying to skate along by being a cog in the system, those cogs aren't going to be necessary in the future, where the AI can do what an MBA can do. Unless you have really good judgment, or you have something special, just being a glorified paper pusher ain't going to pull it anymore. those are the jobs going away because those people usually got above average wages. So that's where the margin is to be saved with AI. We don't need AI to replace somebody who's, trying to make ends meet on a $15 an hour job or $12 an hour job. Corporations going to build their margin by saying, well, if we can have the machines go through all this data, and then we have a smaller group of people making decisions, then we don't need all these people plugging data, right? That's where the money is going to change hands. So if you want to do well in tomorrow's economy, you need a skill that an AI can't do. And AI is threatening my industry. That's why I use it. I use AI all the time. Keep it to myself who I'm using and what I'm using it for. And that's my competitive advantage. But if you can become an engineer or provide a skilled service, whether it's as an esthetician or a plumber or an electrician, if you go into healthcare with aging baby boomers, and now all the kids being born with millennials, which is, we don't need that many more pediatricians, but I know we're short on pediatricians too. If you can do something, if you choose to do something that requires a little bit more skill, you're going to do pretty well. Now, it's going to take a whole generation to fill these jobs. You realize that. We have to educate the people to do this because it's really not the 35-year-old who's going to take those jobs. It's the 15-year-old who we make sure get a good high school and college education or some sort of skilled education. So that's another thing I've learned. Change is good. Education is good. It leads to a lot of good things, but people hate. They have to do the work. So let's talk about investing straight away. This is the AAII Investor Sentiment Report, and it's pretty average right now. In fact, the bullish and bearish have flipped in the last couple of weeks. We have more people being bearish than average. Neutral is just about exactly the historical average, and bullish has come down. But this doesn't jive. This is the AAII survey, which is a subsegment. When you take a look at the investor confidence survey and the consumer confidence survey, they're at all-time highs. So what that says is that people who really pay attention to investments, who take the time to learn how investments work, are a little bit more measured. Here is current asset allocations for the AAII crowd. 67% in equities. This is a chart that I think is pretty useful. Equities reached a high right before the tech wreck as a percentage of portfolios. Got back up into this range, which seems to be the normal range. Crashed again for the Great Recession. What does this exemplify? People are buying at the highs, selling at the lows. Buying up high, selling down low. And for a decade, we've seen the percentage of assets and equities go up and up and up and up. Why? It's a famous four-letter word, acronym, FOMO, fear of missing out. We're not at an extreme yet. I said that sometime this year we'd get to the extreme, just everybody chasing on. Coronavirus may have changed that, I don't know. But we have big inflection points that typically come in March and May, and then again in the fall. So we'll see how overbought we get and how much people are chasing. But this is a pretty good chart. Interestingly, cash, a couple of years ago, and bonds flipped places. People are choosing to hold more cash and less bonds, which is, I've been preaching that to you since day one. Bonds are worthless at this point. You want to try to chase a point here and a point there, have at it. But if we ever have the situation, either ahead of time or on a crisis, where they say, you know what, we are just going to print the money, bonds are going to get destroyed. Because they print 20, 30 trillion dollars, right? That's inflationary. Even if they use a lockbox for Social Security and the retirement system, still inflationary. All of a sudden, bond rates might finally normalize back to that 4 to 5% range on the U.S. Treasury. What's the 20-year U.S. Treasury right now? 1.8% or something? Or maybe that's the 10-year. Regardless, they're super low. So as an investor, we need to be cognizant of the fact that even though these people in this survey are a little bit more bearish than normal, they're way overweight in equities. What does that tell you? There's no other alternative, is how they feel. What happens when the buybacks, which have been 100% of the net buying in the market, turn down, as it looks like they just did? What happens if buyback drop $100 or $200 billion? Can the Fed just keep printing money? Maybe, I don't know. The Fed's been expanding their balance sheet again, and it just leveled off in the last couple of weeks, although they've had a couple of big days. So since autumn, since September, Federal Reserve has printed, I say printed, and we know that's the wrong word, about $800 billion. Don't want to get my trillions and billions mixed up. At some point, that's a mistake. In any case, we know the buybacks are turning over. And I said way back here that whenever this happened, we get pressure on the markets. Future talk is going to be about Bitcoin. Another future talk is going to be about alternative energy. So let's take a look at the stock market indicators. Are we really horribly overbought? Are we really on the verge of a collapse? Last time that we had similar metrics was 1999. And we got the big collapse in the stock market. We got the rise here on easy money and tax breaks that mainly went to the rich. And then we got the Great Recession. And now the extremely long expansion. How high can this go? I don't know. Can it go up here and set a new record? Maybe. Nobody knows. Because the system is manipulated by money. And this is what we're culminating up to, is this last chart. We don't know at what point this becomes too extreme. We just know that in the past it has been. So let's take a look at this chart. This is the chart that I want you to take away and think about. How does it impact you? Can the juice last forever? Nobody knows. So during the Great Recession, the Federal Reserve started doing quantitative easing. The one drop was straight up, just created money. And then they kept adding money, different quantitative easing programs. And the stock market followed. Federal Reserve stopped QE for a couple of years. Stock market flattened. President Trump did the massive tax breaks. Stock market started going back up again. Different juice, but juice nonetheless. Fed started to tighten. Market got choppy for a year. Had the big sell-off in 2018. Right? And recently, right, 'cause it was a long period, it took them to get back. But the corporate tax breaks drove profits up and earnings went up. Market got choppy again right here last summer. Right, we had the correction, little rally, then our correction. And then the Fed suddenly, a month ahead of time, and really more than a month ahead of time, it was about a year ahead of time, and then another month ahead of time, because they surprised us. And they stopped with the quantitative tightening. And we were thinking, okay, they're not going to be tightening, and we're just going to get normalcy, more price discovery based on earnings. But that didn't even happen, because just a month later, something really bad happened in the repo market, which is the lending between financial institutions, and it all dried up. Interest rates jumped from 2% to 8 to 10% in an hour. An hour. So the Fed starts printing money again. Again, wrong word, pumping money into the system. Balance sheet stuff. Federal Reserve balance sheet goes up. Stock market follows. Now the Federal Reserve has leveled off. Will they stay level? Or will they pump it all the way back up to where it was just 2 years ago? In which case, I think we need to ask the question, what was the point? I've said, and I have this on pretty good authority, that there were a couple of financial institutions, or 3 or 4 or 5, somewhere between 1 and 5, financial institutions that had to unwind a lot of leverage. Otherwise, they were going to have long-term capital moments, basically collapses. I speculate that AQR was one of them. And I think there's a few more. So if they had to unwind hundreds of billions of dollars of leveraged bets that may have been levered up at 5 and 6 and 10 or 12 to 1. Remember, Lehman Brothers was 100 to 1, and the rest of the banking institutions were 30 to 50 to 1. That means that if they had $100 billion invested at 10 to 1, that's $1 trillion that somehow had to get unwound. Federal Reserve has added about $800 billion to their balance sheet. It's $800 billion that went back into the banking system. That probably got lent to hedge funds. So hopefully they unwound their leverage and adjusted their portfolios. Now, throw something out there for you. Hedge fund guys are pretty interested in making money. What if they took the money and they didn't unwind their leverage? What if they just made more bets? And what if the Federal Reserve throws up their arms at some point and says, you know what? Enough is enough. Let's play out. There's more charts I can show you. Financial leverage in the system is high again, about as high as it was in 2006 and 7. That means that the margin of error, margin of safety, that is necessary to fight off any shock to the system is extremely thin. I want you to visualize this. If you watched Vikings, which I've been watching, you just saw this play out a couple seasons ago. Imagine a big lake freezing over. We know that the ice is thinnest in the middle. And the weather is warm now. The ice starts to melt. But people still have their trucks out. You know, if you're in the Midwest, you get this one. If you're in Minnesota, Michigan, Wisconsin, you get this one. But they have their trucks out on the ice because they're ice fishing. What happens when there's people out on the ice and it's thinning and they keep going out into the middle? Eventually they fall through and it's straight down and the water's cold. People in their FOMO, their fear of missing out, are going out on the thinner and thinner ice, relying on the Federal Reserve to take care of them. We already know that the big four banks don't want to lend money because they've been buying U.S. treasuries and because they don't have any other ways to make money. They're having a hard time making money. Now, they're keeping up because their loans are getting paid back right now. But again, I point out, what if unemployment ticks up? What if the coronavirus is the thing that spurs the skip straight recession that I've talked about? What if China really is rope-a-doping President Trump, which research is showing is probably what happened? And now they're going to use coronavirus to get concessions. And I'm not saying coronavirus isn't a horrible thing, but more people are still dying of the flu. I just want you to think about risk and risk management. In the last 25 years, I've learned, sometimes because I got ahead of the curve, sometimes because the curve beat me over the head. Risk management is everything. There is always another opportunity because the world does keep getting better. You should never have a fear of missing this opportunity. Protect your money. Cash is fine. Cash is king. Because when the next opportunity comes, you'll be able to do like Warren Buffett's going to be able to do, right? Warren Buffett has saved up more cash in the last 4 years than he's ever saved up before. It's back in here. This way down here. He started to see valuations getting out of whack. I've had that chart up before too. We know the valuations are way out of whack. You know, one of the other things that helped us was low oil prices, right? Energy started to get cheap. And that might be one of the things that we experience for the next, maybe forever. Energy is going to get cheaper. We're never again going to have to deal with spikes in energy prices. Think about that. There's so much natural gas right now, and oil demand is flat and might turn over sooner than 2030. I just can't see it being later. But all these people with oil, all these companies and countries with oil need to make some money on that resource. So even if we get the little pop in oil prices early this decade that I talk about, it's not going to last. I mean, the real wild card in energy is there a disruption? If it wasn't for the fact that there might be a disruption, I wouldn't own any oil stocks. I only hold what I hold anymore because of the potential for disruption. If there is a disruption, they spike up, and everybody starts going, "Oh, I got to own oil stocks." I'll sell them mine, and then I'll never buy them back ever again. And in fact, I think we're gonna get a great shorting opportunity a few years from now. So take a look at this chart. Think about the risk that it entails. Think about the fact that we're up to $22 or $23 trillion in national debt. We're running a $1.3 trillion deficit during what is supposedly the greatest economy in history of mankind. Why is the Federal Reserve juicing the economy? Why are we running a $1.3 trillion deficit if everything is so good? These are legitimate questions. Why would anybody want to chase stocks when they're so overvalued? Because you're afraid of missing out on that? Think back 4 years. There was a Monday that everybody woke up and the stock market was limit down 10%. Think about December 2018 when the market went straight down for a month. Those aren't just harbingers. Those should be telling you that the system has an underlying flaw. Something to do with the perpetual selling by the boomer generation and their institutions. Something to do with foreign money not moving. Something to do with all the cash that's out there, whatever it is, $300 trillion or whatever, offset by whatever it is, 600 trillion in debt. There's way more debt out there in the world than there is cash. So keep that in mind when people like Thomas Lee at Fundstrat say, oh, yeah, there's all this cash that's got to come into the markets. No, it doesn't. Think about you. If you have debt, you're also holding extra cash in case something bad happens and you got to pay that debt anyway. The cash that is not invested right now is an offset against debt. It's not just money that's idle. It's the other side of the ledger. There is no giant wave of cash coming into these markets. If there were, the Federal Reserve wouldn't have to be doing this. And we would not be running a $1.3 trillion deficit during an expansion and a bull market. I can't promise you anything. Can't guarantee you anything. But I think the second half of this year is going to be really, really rough. I think this coronavirus pullback, it's going to be, hasn't been really a pullback yet. Yeah, a couple percent a couple of times. But I think that's going to give us the one bad quarter that I've talked about. Market will react to that. And then it'll rally. At some point, the politics matter. I am telling you that the private polling data that I've shared with you is correct. President Trump will not get 60 million votes. He had 63 million to win last time. He won't get 60 million. He might be closer to 55, but let's just say under 60 million. He can't win the election with under 60 million votes. And that's not even taking into account that the Democrats probably have record turnout. And if they run Michelle Obama or Stacey Abrams as the VP, right? This is just demographics. If they run a black woman for vice president, that's an awful lot of votes. So, if President Trump was smart, he'd dump Pence and he'd go get a black woman to run with him, or Hispanic. Right? I mean, another old white guy. Well, what does Pence bring to the ticket? The evangelicals are already mad at Trump. There's no path to victory for him. And that matters this year for our investing. It really does. So, even without that, even if Trump would win, I think that just puts all this off by maybe a year. So whether it's this year or next year, do you want to deal with a system that's so broken that when things are supposedly good, we're adding all this juice? The punch bowl always gets taken away. I've learned that over the last 50 years and 25 years. The punch bowl always goes away. Save up your cash if you're younger. Pay down your debts. If you're an investor, suck it up and be happy with a single-digit return somehow this year, with a lot of your money in cash and just a few good investments and using options maybe to create some income. And if we get a couple of setups, maybe we can do some hedging. But hedging is so hard to do that we need perfect setups. Because we had a good setup a few months ago, and it ended up being a break-even trade that was risky. I don't want break-evens that are risky. I want something extremely low risk where I either can go, okay, I can live with it breaking even because there wasn't much at risk, but maybe I can make a bunch of money. So keep an eye on the VIX. That VIX gets pushed back down under 12. We need to start thinking real hard. This S&P 500 gets to my target of around 3,600. We need to think really hard. Because everything's telling me something's broken. And really, there's several things broken. Something's going to come to a head. Probably this year. If not this year, then soon after. And if you play it right, you're going to make a lot of money. Because you're going to get to buy low. And take a look at the various short lists that I put out there. Take a look at those bottom fishing prices. And go back on your charts to see when the last time those bottom fishing prices hit. It wasn't that long ago. It wasn't that long ago. A lot of them hit in 2018, and a lot of them were there in 2015 and 16. Stock market's going to drop between 20 and 60% soon. So prepare for it. FOGYAK, not FOMO. Fear of getting your assets kicked. That's where you should be right now. All right, let me stop recording, then I'll take a couple of questions.